Imagine finally hitting that major financial milestone after years of discipline, sacrifices, and smart investments, only to realize that sharing your success might actually put your wealth and peace of mind at risk. Today, we are diving into a crucial financial truth that many people learn the hard way: why you should keep your serious savings and net worth private. Whether you are just starting your wealth-building journey, looking to protect your hard-earned capital, or aiming to scale your portfolio to the next level, understanding the psychological, social, and financial dangers of oversharing is essential. In this video, we will explore exactly why remaining low-key about your financial milestones protects you from unwanted expectations, toxic comparisons, and even financial scams, allowing you to focus purely on compounding your wealth and securing your financial freedom. Part 1. The psychological pressure of lifestyle inflation. When your savings grow and your net worth increases, a hidden psychological trap often emerges in the form of lifestyle inflation. This phenomenon occurs when your spending increases as your income or savings grow, making it incredibly difficult to maintain a steady rate of wealth accumulation. People begin to feel a subconscious urge to upgrade their living situations, vehicles, and daily habits to match their perceived new social status. This behavior is driven by the desire to validate one's success to peers and the broader community, yet it subtly drains the capital that should be working for you through compound interest. To prevent this, you must separate your psychological need for validation from your actual financial progress, recognizing that the most successful wealth builders focus on what their money can produce rather than what it can display. The pressure to conform to higher living standards affects individuals at every stage of their financial journey. For beginners, it might look like upgrading an apartment or buying a new car as soon as they receive a raise or a bonus. For intermediate investors, the trap often manifests in luxury travel, expensive dining, or joining exclusive clubs that offer minimal return on investment. Even advanced investors are not immune, as they may feel compelled to purchase larger real estate or high-end assets to fit in with their high-net-worth circles. This continuous cycle of upgrading creates a treadmill effect where you are forced to earn more just to maintain a lifestyle that provides diminishing returns on happiness. By keeping your serious savings and net worth private, you remove the external audience, which significantly reduces the psychological burden of having to maintain an extravagant facade. To take actionable steps against lifestyle inflation, you must redefine your relationship with your wealth and prioritize stealth savings over public consumption. One effective method is to automate your savings and investments before you even see your liquid cash, treating your financial goals like non-negotiable bills. When you receive a raise or a financial windfall, redirect the majority of those funds directly into investment portfolios or high-yield savings accounts rather than allocating them to discretionary spending. You can also practice delayed gratification by waiting at least 30 days before making a non-essential luxury purchase, which gives the emotional impulse time to fade. By decoupling your self-worth from your material possessions and keeping your financial achievements to yourself, you protect your capital, reduce unnecessary stress, and keep your long-term wealth compounding in the background. Part 2. Protecting personal relationships from financial envy. When individuals around you become aware of your substantial savings or increasing net worth, the dynamics of your personal and professional relationships can change rapidly. People often project their own financial insecurities onto you, leading to feelings of resentment or unrealistic expectations regarding how you should use your money. For beginners, this might manifest as friends or family assuming you should pay for group meals or help fund personal emergencies. Intermediate investors might face pressure from acquaintances seeking financial advice or investments for unproven ventures, while advanced investors could deal with complex family dynamics regarding inheritances or business partnerships. Protecting your personal relationships requires an understanding that sharing financial details rarely brings people closer and frequently introduces a transactional nature to previously genuine connections. Envy is a powerful and destructive emotion that can quietly erode the foundation of even the closest friendships and family ties. When people know exactly how much you have saved, they may begin to compare their own progress to yours, viewing your success not as a result of hard work and discipline, but as a stroke of luck or unfair advantage. This can lead to passive-aggressive comments, alienation, or direct requests for financial support that you are not comfortable providing. If you refuse these requests, you risk being labeled as greedy or unsupportive, regardless of how much effort you put into building that wealth. By maintaining strict privacy regarding your financial milestones, you remove the fuel for these comparisons, allowing friends and family to interact with you based on who you are, not what you have in the bank. To safeguard your relationships without becoming socially isolated, you must establish firm boundaries and adopt a habit of humble communication. When discussing your career or business, focus on the effort and skills required rather than the financial rewards or the size of your portfolio. If someone asks about your financial situation, use vague responses such as managing to get by or focusing on long-term stability, which discourages further probing without causing conflict. Should a friend or family member ask for a loan, establish a strict policy of separating money from personal relationships, perhaps offering non-financial support or simply stating that your capital is tied up in long-term investments that cannot be liquidated. Keeping your wealth private allows you to maintain authentic connections while ensuring your financial security remains intact. Part 3. Avoiding scams and financial predators. When your financial success becomes visible to the public or even to your extended network, you inadvertently paint a target on your back for financial predators and sophisticated scams. Beginners are often targeted with get-rich-quick schemes, binary options, or multi-level marketing traps because predators assume they lack the experience to spot red flags. Intermediate investors might face aggressive pitches for speculative real estate deals, private equities with unrealistic returns, or unverified crypto projects. Advanced investors are not immune either, as they are frequently approached by individuals or businesses seeking to leverage their wealth for risky ventures or complex tax schemes. By keeping your financial status hidden, you avoid being identified as a potential mark, significantly reducing the likelihood of becoming a target for fraudulent activities. Predators often use sophisticated psychological tactics to exploit the wealth and confidence of individuals who have recently accumulated serious savings. They might appeal to your desire to multiply your money quickly, using social proof, fake testimonials, or a false sense of urgency to push you into making hasty financial decisions. In many cases, these individuals leverage the concept of lifestyle and status, promising access to exclusive circles or high-status investments that are reserved only for the wealthy. Recognizing these warning signs is critical for preserving your capital, as true wealth building is a slow and calculated process rather than a sudden leap based on an exclusive opportunity. Understanding that most unsolicited investment offers are designed to benefit the other party rather than yourself is a vital defense mechanism. To take actionable steps against financial predators, you must implement a strict policy of due diligence and maintain complete anonymity regarding the exact figures of your wealth. Always conduct independent research, consult with verified and licensed financial advisors, and avoid making investment decisions based on social pressure or emotional appeal. If an opportunity seems too good to be true, or if someone pressures you to commit funds immediately, treat it as an immediate red flag and walk away. By guarding your financial information and treating every new investment opportunity with skepticism and thorough analysis, You protect your hard-earned capital from opportunistic predators and ensure your wealth remains safe and secure. Part 4. The power of stealth wealth. Practicing stealth wealth is one of the most effective strategies for long-term financial survival and compounding success. This approach involves living well below your means and avoiding the temptation to display your financial achievements to the public. For beginners, this means focusing on clearing debt and building a robust emergency fund without trying to match the spending habits of peers who may be living on credit. Intermediate investors benefit by channeling excess cash flow into productive assets rather than upgrading their vehicles or homes, ensuring their portfolio grows at an accelerated rate. Advanced investors rely on stealth wealth to protect their privacy, maintain anonymity, and avoid the complex social obligations and legal vulnerabilities that come with being visibly wealthy. The concept is rooted in the understanding that the true power of money lies in what it can generate, not what it can buy. When you adopt a stealth wealth mindset, you shift your focus from external validation to internal security and compounding returns. This psychological shift insulates you from the comparison trap and allows you to make objective, data-driven investment decisions without the emotional baggage of maintaining a high-status image. By keeping your net worth out of public view, you preserve your mental energy, reduce the noise and distractions of societal expectations, and create an environment where your capital can grow silently and efficiently over time. To implement the power of stealth wealth in your daily life, you must adopt habits that prioritize anonymity and financial efficiency over outward appearances. Choose to drive reliable, unassuming vehicles and reside in comfortable, modest neighborhoods rather than purchasing expensive real estate just to impress others. Avoid discussing your income, portfolio size, or business ventures with friends and acquaintances, focusing instead on personal growth or general economic topics. You can also utilize privacy structures, such as trusts or holding companies, to protect your real estate and business assets from public records. By remaining understated and focused on the foundational growth of your wealth, you ensure long-term stability and true financial freedom. Part 5. Practical strategies for managing discrete savings. Managing and organizing large amounts of capital while maintaining discretion requires a strategic approach to your banking and financial infrastructure. For beginners, this means opening accounts at different online banks that are separate from your primary checking account to keep your main wealth out of sight. Intermediate investors can benefit from using specialized business or personal entities that shield their personal name from public registries and transactions. Advanced investors might utilize offshore accounts, trusts, or anonymous holding corporations to layer their privacy and protect substantial capital from being easily traced or exposed. These structural setups ensure that your money remains shielded from prying eyes and unnecessary administrative scrutiny. Another crucial strategy involves how you execute daily transactions and manage cash flow without drawing attention to your financial status. When you make large purchases or invest in new assets, route these transactions through accounts that do not bear your personal name, or use corporate cards tied to your business entities rather than personal checking accounts. It is also important to be mindful of digital footprints, such as using secure email addresses for financial correspondence and avoiding public Wi-Fi when accessing your investment portfolios. This level of operational security prevents data breaches and ensures that your financial footprint remains completely anonymous to outside observers. To maintain the secrecy of your savings over the long term, you must regularly audit your digital presence and the public visibility of your assets. Remove your name from public property directories by utilizing land trusts or anonymous LLCs when purchasing real estate or valuable assets. Additionally, automate the transfer of your savings into diversified index funds or decentralized assets that do not require public disclosure. By integrating these technical and operational strategies into your wealth-building routine, you create an impenetrable barrier between your personal life and your financial capital, allowing you to focus purely on the growth and preservation of your wealth. In conclusion, building serious wealth is not just about earning and saving, but also about protecting what you have built from the psychological, social, and financial risks that come with oversharing. By keeping your net worth private, you insulate yourself from the pressures of lifestyle inflation, shield your personal relationships from envy, and keep financial predators at bay while practicing the true power of stealth wealth. If you found this information valuable and want to continue learning how to grow and protect your money, be sure to subscribe to the channel so you never miss our upcoming financial insights. We would love to hear your thoughts, so leave a comment below with your favorite takeaway or a phrase referring to today's video, and let us know how you plan to keep your financial journey discreet.